This discussion did not return by accident. It came back because the gap between Social Security benefits and real-life expenses has grown wider. Even with recent cost of living adjustments, many seniors are finding that their monthly checks simply do not stretch the way they used to. If you're interested in this topic, hit the like button, subscribe, and type "interested" in the comments, and I will give you a heart. Rent has increased faster than expected in many areas. Grocery prices remain elevated. Insurance premiums continue to rise quietly. Out-of-pocket medical costs add pressure month after month. Federal agencies track these trends closely. They compare benefit growth against actual household spending, not averages on paper. Recent internal reviews show that for a growing number of seniors, benefits are falling behind essential costs. That finding alone is enough to restart serious internal discussions. This is not about politics or headlines. It is about math. And the math is forcing another look at whether current benefit formulas are doing what they were designed to do. Timing plays a larger role here than most people realize. The federal government is entering a period where multiple reviews overlap. Budget planning, benefit recalculations, and policy evaluations are happening close together instead of years apart. When those processes align, it creates a narrow window where supplemental payments or one-time relief measures are easier to implement than usual. That window is open now. This does not guarantee any payment, but it does mean options that were previously set aside are being actively reviewed again. Public data showing increased financial strain among seniors adds to that momentum. When missed rent, delayed care, and credit reliance all rise at the same time, agencies take notice. That is why this conversation has shifted from vague language to specific dollar modeling. The alignment of these review cycles matters because it reduces bureaucratic friction. Normally, proposing a new payment mechanism requires separate approvals across multiple departments, each operating on different timelines. Congressional committees review budget proposals in one season, while the Social Security Administration handles benefit adjustments in another. Treasury involvement adds a third layer of scheduling complexity. When these cycles are out of sync, even modest proposals can take years to move through the system, stalling in committees or waiting for the next appropriate legislative vehicle. Right now, that fragmentation has temporarily dissolved. The fiscal year planning process, Social Security's annual cost of living adjustment review, and broader economic relief discussions are all active simultaneously. This creates unusual leverage for proposals that would normally struggle to gain traction. A supplemental payment attached to existing infrastructure becomes administratively simpler when the infrastructure itself is already under review. Agencies that would typically need months to coordinate can now work from shared timelines and unified budget projections. Economic indicators have also reached a threshold that demands attention. Data on senior financial distress is not anecdotal anymore. It shows up in mortgage delinquency rates, healthcare deferral statistics, and emergency credit usage among retirees. When these metrics move in the same direction across multiple datasets, they create a documented case that is harder to dismiss. Policymakers respond differently to isolated complaints than they do to systemic trends backed by federal reporting. The current data presents the latter, which shifts internal discussions from "if something should be done" to "what can be done within existing authority." The modeling phase reflects this shift in tone. Agencies are no longer asking whether relief is justified, they are calculating what various payment amounts would cost, how quickly they could be distributed, and which recipient groups would see the greatest impact. Those calculations involve running scenarios through payment systems that already exist, identifying potential bottlenecks, and estimating timelines for implementation. This level of operational planning does not happen unless there is genuine consideration of moving forward, even if no final decision has been made. Political momentum also factors into timing. Election cycles, legislative calendars, and public pressure all influence when proposals gain traction or lose it. Relief measures tend to move faster when they align with broader policy goals already in motion. If workforce participation among older adults, healthcare access, or inflation concerns are already legislative priorities, adding targeted payments to that framework becomes easier. The current environment includes all three, which means a supplemental payment proposal fits within existing conversations rather than requiring an entirely new debate. None of this guarantees action, but it changes the probability. Windows like this close as quickly as they open, which is why the language around potential payments has become more concrete. Agencies are working within a time frame, not an abstract future possibility. The $2,000 number is widely misunderstood. It is not a confirmed payment. It is not an announcement. It is a benchmark. Policymakers use specific figures to measure how far behind certain households may be. $2,000 represents an amount large enough to stabilize many seniors temporarily, not just symbolically. In some discussions, it reflects a possible one-time payment. In others, it represents combined relief such as retroactive adjustments, corrected underpayments, or temporary supplements. That is why people hear the same number used in different ways. To seniors, these deposits can feel like stimulus checks even when they are technically owed benefits being corrected or adjusted. This overlap is one reason confusion spreads quickly. Understanding the difference helps seniors stay grounded. The figure itself emerged from affordability modeling, not political messaging. Analysts calculate what amount would cover common shortfalls, delayed property taxes, overdue medical bills, necessary home repairs, without creating excessive budget strain. $2,000 consistently appears in those models because it sits at the intersection of meaningful impact and fiscal plausibility. Smaller amounts risk being absorbed by single expenses without stabilizing a household. Larger amounts trigger different approval thresholds and complicate distribution timelines. This specific figure has mathematical reasoning behind it, even when it gets repeated without that context. The terminology matters more than most realize. A stimulus payment implies new spending intended to boost economic activity. A corrected underpayment represents money that should have been distributed earlier but was delayed due to calculation errors or processing backlogs. A supplemental benefit falls somewhere between. It acknowledges gaps in existing support without labeling them as errors. All three can result in the same deposit amount reaching the same bank accounts, but they carry different legal frameworks, different approval processes, and different implications for future payments. When officials discuss $2,000, they may be referring to any of these categories, and the distinction often gets lost in translation. Retroactive adjustments add another layer of complexity. Social Security periodically identifies recipients who were underpaid due to formula errors, outdated spousal calculations, or missed eligibility expansions. When those corrections are issued, they can arrive as lump sums that match or exceed $2,000. These are not new benefits, they are delayed portions of existing ones. But to someone who was not expecting additional money, the experience feels identical to receiving relief. The confusion is understandable, especially when multiple people receive similar amounts around the same time, creating the appearance of a coordinated payment program even when the deposits stem from unrelated individual corrections. Media coverage amplifies the ambiguity. Headlines simplify complex policy discussions into digestible claims, often stripping away the nuance that separates possibilities from certainties. A statement like, "Agencies are evaluating $2,000 payments for seniors," can be accurate while simultaneously misleading. It accurately reflects internal discussions without confirming any decision has been made. Readers interpret that headline as confirmation, especially when they see it repeated across multiple outlets. Each repetition reinforces the perception that something definitive has been announced, even when the underlying reality remains speculative. This dynamic creates a cycle that is difficult to interrupt. Seniors who hear about potential payments begin planning around them. When those payments do not materialize on expected timelines, frustration builds. That frustration fuels demand for more information, which generates more coverage, which creates more expectations. Meanwhile, actual policy development moves at its own pace, unaffected by external speculation. The gap between public expectation and bureaucratic reality widens, making eventual communication from official sources harder to trust because it often arrives later than people want and contains less certainty than they expect. Staying grounded requires distinguishing between what is being discussed and what has been decided. The $2,000 figure appearing in internal documents or committee testimony indicates serious consideration, but it does not indicate approval. Approval requires specific legislative action or executive authorization, both of which generate official announcements through recognized channels. Until those announcements exist, the number remains a planning tool rather than a commitment. Not all seniors experience inflation the same way. Those receiving Social Security retirement benefits are being reviewed primarily for adequacy. The question is whether monthly checks still reflect real living costs. SSI recipients face a more urgent challenge. Benefits are modest by design, and inflation hits this group first. A one-time payment would have a far greater impact here than a small monthly increase. SSDI recipients are also central to this review. Many have no ability to increase income when costs rise. Policymakers are reassessing whether disability formulas reflect modern expenses. Veterans are not excluded either. While VA benefits operate separately, coordination often occurs during periods of economic stress. This is why the same dollar figure appears across multiple programs. It is not one system. It is a shared pressure point. The differences in vulnerability stem from benefit structures themselves. Social Security retirement benefits typically replace a percentage of prior earnings, which means recipients who worked in higher-wage jobs receive larger monthly checks. These individuals may experience inflation as uncomfortable but manageable. They can absorb rising grocery costs or adjust discretionary spending. In contrast, SSI recipients receive a flat federal benefit amount that assumes minimal resources and no substantial work history. When food prices rise by 20% over 2 years, someone receiving $900 monthly feels that increase far more acutely than someone receiving $2,400. The same inflation rate produces vastly different household outcomes depending on which program provides support. Geographic variation compounds these disparities. Cost of living adjustments apply uniformly across the country, but actual living costs do not. A recipient in rural Mississippi faces different housing and healthcare expenses than one in metropolitan California. SSI recipients in high-cost areas often rely on state supplements to bridge the gap, but those supplements do not always keep pace with local inflation. SSDI recipients face similar challenges, particularly when disability-related expenses, specialized equipment, accessible housing, recurring medical care, rise faster than general consumer prices. The federal adjustment mechanism was never designed to capture these localized pressures, which is why some recipients fall behind even when official inflation metrics suggest benefits are keeping up. Income flexibility separates retirees from other beneficiary groups in critical ways. Many Social Security retirement recipients can supplement their benefits through part-time work, investment income, or family support. That flexibility provides a buffer when unexpected costs arise. SSDI recipients, by definition, cannot rely on employment to close budget gaps. Earning above certain thresholds jeopardizes benefit eligibility, creating a trap where increased income leads to benefit loss that exceeds the earnings gained. SSI recipients face even stricter asset and income limits, making it nearly impossible to build emergency savings or accept financial help from relatives without triggering reductions. This structural rigidity means that when inflation erodes purchasing power, these groups have no mechanism to recover lost ground through their own efforts. Veterans receiving VA disability compensation encounter a parallel but distinct situation. VA benefits are calculated based on disability ratings rather than work history, and they exist alongside healthcare access through the VA system. When inflation drives up costs, veterans may face choices between purchasing necessities and accessing care that requires travel, copays, or out-of-pocket expenses for services not covered by VA facilities. Coordination between VA and Social Security systems becomes critical during relief efforts because many veterans receive benefits from both, and policymakers must ensure supplemental payments do not inadvertently disqualify recipients from means-tested programs or create unintended tax consequences. The shared pressure point exists because all these programs converge on the same demographic reality. Older adults and people with disabilities disproportionately rely on fixed incomes that cannot expand when costs rise. They also face higher baseline expenses, healthcare, prescription drugs, mobility assistance, that increase faster than general inflation. When agencies model the impact of a $2,000 payment, they are measuring relief across populations that experience economic stress differently but simultaneously. A payment that stabilizes one group may only provide temporary relief to another, which is why discussions about distribution methods and eligibility criteria remain unresolved. This complexity explains why policymakers avoid blanket solutions. A single payment amount distributed uniformly might fail to address the specific vulnerabilities of SSI recipients while overcompensating higher-income retirees. Conversely, highly targeted payments risk excluding groups whose struggles are real but less visible in administrative data. Striking the right balance requires understanding not just who receives benefits, but how those benefits function within vastly different household economies. Preparation does not mean panic. It means awareness. Seniors should make sure their contact information is current with benefit agencies. Address changes, banking details, and representative payee records should be accurate. Many payment delays happen simply because records are outdated. It is also important to open and read official mail carefully. Notices about reviews or adjustments are often overlooked, especially when they do not mention a specific dollar amount. Patience matters too. Policy movement takes time. Silence does not mean nothing is happening. Legitimate changes often happen quietly before becoming public. Be cautious of misinformation. Real benefit changes never require fees and never ask for personal information through calls or texts. Updating records is simpler than most people assume, but it requires intentional action. Social Security allows address and direct deposit changes through the My Social Security online portal, by phone, or in person at local offices. The online method is fastest, but many seniors are more comfortable calling or visiting in person. Regardless of method, having a Social Security number, date of birth, and current mailing address readily available speeds the process. For those who use representative payees, family members or organizations authorized to manage benefits on their behalf, any changes must go through the payee rather than the beneficiary directly. This adds a layer of communication that can delay updates if the payee is unaware changes are needed. Banking information deserves particular attention. Direct deposit remains the most reliable delivery method for federal payments, but it only works when account details are correct. Closed accounts, changed bank ownership, or accounts frozen due to inactivity can all redirect payments into administrative limbo. When this happens, the Social Security Administration typically reverts to issuing paper checks, which take longer to arrive and carry greater risk of loss or theft. Verifying that the bank account on file matches current active accounts prevents unnecessary delays. For those without bank accounts, Treasury's Direct Express Card program provides a prepaid debit option specifically designed for federal benefit recipients, offering similar speed and security without requiring a traditional bank relationship. Official mail often contains critical information buried in dense formatting. Notices about benefit reviews, cost of living adjustments, or eligibility reevaluations arrive on standard government letterhead that can feel impersonal or intimidating. Many recipients set them aside, assuming they contain routine information that does not require immediate attention. In reality, these notices often include deadlines for responding, instructions for providing updated documentation, or explanations of upcoming changes to payment amounts. Missing a deadline because a notice went unread can result in benefit suspensions or delays that take months to resolve. Developing a habit of opening all mail from Social Security, SSI, SSDI, or VA immediately, even when it looks routine, prevents these avoidable complications. The waiting period between policy discussion and implementation can feel frustratingly long. Months may pass between the time an agency begins evaluating relief options and the moment payments actually reach recipients. During that gap, official sources remain deliberately vague, offering few concrete details because decisions have not been finalized. This silence is not evasiveness. It reflects the reality that bureaucratic processes involve multiple approval stages, legal reviews, and coordination across departments. Premature announcements create confusion when details change during final negotiations. Patience during this phase does not mean passivity. It means continuing to monitor official channels while resisting the urge to treat speculation as fact. Scammers exploit uncertainty with precision. When rumors about potential payments circulate, fraudulent calls and messages spike immediately. These scams follow predictable patterns. Claims that a payment is ready but requires verification of personal information, offers to expedite processing for a fee, or threats that benefits will be suspended unless immediate action is taken. Legitimate agencies never operate this way. Social Security will not call unexpectedly demanding information. The IRS does not initiate contact through text messages. Any communication requesting payment to access benefits is fraudulent, without exception. Seniors who receive suspicious contact should hang up, delete the message, and report the incident to the Federal Trade Commission or the Social Security Administration's Office of the Inspector General. Awareness also means recognizing what is within individual control and what is not. Seniors cannot accelerate policy timelines or influence agency decisions through repeated inquiries. They can, however, ensure their own records are accurate, stay informed through official sources, and avoid falling victim to scams that prey on hope and confusion. These actions create a foundation that allows them to respond quickly and correctly when legitimate opportunities or requirements arise. Preparation is not about anticipating every possible outcome, it is about reducing friction when outcomes finally materialize. This moment is not about guaranteed money. It is about recognition. The renewed focus on figures like $2,000 signals that policymakers are once again measuring real financial strain among seniors. That matters. Social Security, SSI, SSDI, and veterans benefits were created to provide stability and dignity after decades of contribution. They are not static systems. They evolve as conditions change. Even if relief does not arrive in the exact form people expect, the pressure driving these discussions will continue. The most important takeaway is this: staying informed puts you in control. Understanding how and why these conversations happen protects you from fear and misinformation. If this affects you or someone you love, type info in the comments. Subscribe so you do not miss updates that actually matter.